Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, October 26th, 5:24 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we continue to be in an uptrend. As you can see over here on the trend gauge, we're showing bullish/uptrend across all three of the time frames that we track for the major moving averages, the 5 that we discuss in every video. Why do we discuss the major averages? Because 75% of stocks will follow the trend of the overall market. So you want to be in sync with the trend of the overall market and then narrow that down to the top sectors and then the top stocks within those sectors. So we are, as I said, positive across the short term, which means all 5 indexes are above the 21-day exponential moving average. Medium term, 50-day moving average. Long term, 200-day moving average. Leaders also acting very bullish. No issues there, although we did see some volatility to the downside today, very similar to what we saw on Friday. Volatility near the highs as the indexes digest this latest move up. We've pretty much had a pretty strong bounce right up since the follow through day on 1014. So natural when you get near the highs to pull back a little bit. That's what we saw with the NASDAQ 100 today when it attempted to break out and reverse. So what happened today, we had a nice gap up and it continued for a little while, then a pretty harsh negative reversal late morning, followed by a bounce, but a weak close. Some divergence across the indexes and leading stocks. You can see the G5 here, which is an index of 5 growth ETFs that we track to keep our pulse on the overall growth stock market, down 0.69%. S&P 500 up 0.2%, led by some value sectors. NASDAQ 100 up 0.3% as the SOX pretty much led their strong day by NVIDIA. And after hours, AMD reported they're about flat. Dow Jones Industrial Average up a fraction. Mid caps and Russell down 6 and 7/10 respectively. So let's take a look at the indexes. But first, let's take a look at the team here running Revere. We are a fully transparent active advisor, strives to participate in market uptrends, reduce exposure and lock in gains if the market gets too extended or starts consolidating sideways. And then we really want to be out of the way if we've got a true bear market. So from the bear market studies I've done, if you're going to be down 20, 25, 30%, first you've got to break all the moving averages above there, those being the 21, the 50, and most importantly, the 200. If you're going to be down 25% on average, first you're going to break the 200-day moving average, and that's normally 12% off a high. So that's really the key levels, the 200-day moving average. That's when we will get the heck completely out of the way on a break of the 200-day moving average, very similar to what we did during COVID. You can go back and take a look at the videos that we produce. We never edit anything. If you want to see how we acted, getting out of the way and then getting back in, I would invite you to, and then send any questions our way. You can email any of us, Dan, Tim, Hunter, Muriel, Alex, or Don at revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. Very critical not to get caught in harsh market downturns, especially as you approach retirement, because the sequence of returns concept says that while the market generally returns 8 to 9% annually, you don't get that every year. If you did, investing would be easy, but it's those negative 20%, negative 30% back-to-back years like we saw during the financial crisis or during the bursting of the internet bubble that can really dent your portfolio, and that's what we excel at, getting out of the way. So give us a shout if you're interested. So let's get to the major indexes. We'll start off there. We took a little bit off the table today. As we got, not necessarily extended versus the 21 and the 50-day moving average. 2.4% above the 21, 2.8% above the 50. But the straight up move from the 10-13 low and the 10-14 gap up, and then a harsh reversal. This is the first ugly candle really that we've seen since then. So we got some decent gains in some things, took a little bit of those off. We saw a hard reversal in a thing or two, and sold a little bit of that, so we'll get into that momentarily. But here you see the S&P 500 with the negative reversal as we approached 4,600 level. Let's look at this on a 5-minute chart. You can see the gap up and the continuation came right within a hair of 4,600. Pause there a little bit, then a pretty harsh rollover and reversal late morning into noon, followed by a decent bounce, attempt to break out of that bounce level, and then a sell-off into the close. All things considered, if we break this out, let's take a look at the 60-minute chart. This really is nothing to be concerned about at this point. If we keep getting a couple of days of these back-to-back, and then we get down near this 4,500 area, that's when we start to get concerned if we start breaking moving averages. But for now, it's normal digestion after a strong move up, and you can see the move up here over the last 8-9 sessions. So for now, not a big deal. NASDAQ 100, here's the reversal. You can see the cup base being formed here. 382.78 is the high on the left side. We got to 382.71 before we reversed. Again, let's look at the 5-minute chart here. See the gap up, continuation, got close to the high on the left of the cup base, harsh pullback, little trend higher into the close before a little bit of a sell-off the last 15 minutes. So NASDAQ 100, first time taking a breather again, first ugly candle off the move up. One by itself, no concern. It's if we start stringing distribution together that we will get concerned. Here's the Dow Jones Industrial Average. Got to new all-time highs and then reversed again. Nothing to really be overly concerned about. We're just looking to see if these things really start stringing together. A couple of days of distribution followed by breakdown in leading stocks, and that will give us the clue to lighten up a little bit. Mid caps at all-time highs over the last 2 days, giving back a little bit down to the top of the pivot, this 507.63 area. We're still above it at 508.90. So just a pull back to the pivot there. And then IWM hasn't broken out yet, made new recent highs above this 229.84 area, and then reversed also. So several of the indexes making either all-time or recent highs, or testing recent highs and then pulling back from there. But you can see they're all pretty much riding up this faint purple line. That is the 8-day moving average. That's a very strong market that's riding the ADMA up. You got to first break the ADMA to test the 21 after that, and then usually the first test of the 21 holds, and it's a good time to be adding exposure if you trim some at the top, which is what we did a little bit today. You can see every one of the indexes riding the 8 EMA higher, and until that changes, nothing to get overly concerned about. So let's go to the market facts here. As I mentioned, in an uptrend since 1014, combination of headwinds and with rising rates and the strong dollar, although the dollar has bounced 2 consecutive days now off of a kind of a normal reaction area. So what we want to see is what the next move is going to be on the dollar. So it got back above the 21 today. So if it continues higher, that's going to be an issue for stocks. You can see we broke below the 21, and the 21 rolled over last week, and that coincided with a nice week in stocks. Today, the strength in the dollar corresponded with a little bit of weakness in stocks, and this is definitely something to monitor. The dollar trudging higher, and then when it reached the highs of the days, that was about the time that the market rolled over a little bit. The dollar started coming back a little bit then, and that's the time when the market was rallying into the afternoon. And then I mentioned the not so strong close, but we want to keep an eye on what happens to the dollar, absolutely. And as far as the 10-year bond goes, pulling back 3 straight days after it came into these recent highs back from March and April, pulling back. We can pull all the way back to the 21 without any kind of a change in trend there. So that's something else that we definitely are keeping our eye on. Sentiment in the put-call ratio kind of going to neutral, away from actually being a tailwind, and kind of neutral now. But the bull case that we're observing is we want to stay above the 21 and the 50-day moving average. And a bearishness wouldn't really kick in unless we broke below this 44.30 level, which was the prior breakout. Strong today, oils, transports, and utilities. Very nice day by UPS. They reported earnings, and you can see the big gap up on nice volume, 150% above average volume coming to the top of this flat base. See if it puts in a handle here before it powers above, excuse me, 220. I'm going to set an alert here at 220 on this. Transports have been acting pretty well lately. Weakness today in banks. ITA, which is aerospace and defense, and we sold our ITA today. It really underperformed since we bought it, and it really kind of seemed to be just a matter of, you can see the relative strength in it. We bought it with this little move up out of there, and immediately it started not only not making progress, but lagging on a relative basis. And then this morning, Lockheed Martin reported really bad earnings, and it gapped down excuse me. Lockheed gapping down 12% on the day, and that carried over to Northrop Grumman, Raytheon, Harris, and so we sold our ITA position today for a small loss when it broke below the 21 there. Let's see what else. XME metals, base metals, down today, and gold, silver, and gold and silver stocks, which my shorthand is GSX for those. So we closed at 45.75, 45.46, the prior all-time highs. Let's see what we pull back and test there. And we've got the rising 80 MA at 45.26. So these are the first two levels where we would expect a strong market to bounce. In fact, we bounced today at 45.69, so above the prior breakout level. If that holds, we're still in good shape. If we pull back after that, we're looking at 45.46 and 45.26. This will rise up. The 80 MA will obviously rise a little bit tomorrow. And then you've got the 923 high of 44.65, which is the next level down. Then you've got the 21-day and the 50-day moving average. And if we break all of these and we get into this 44.30 prior pullback area, we will have had a lot of stops go off, and we'll be considering hedging whatever index exposure we have left. And then the 200-day moving average is all the way down 9% lower. So that's our market outlook for now, both bullish and bearish. I've been asked to come. First, I want to take a look at some stocks that stood out today. Tesla, very strong move early following up on yesterday's big volume breakout, got a little bit of ahead of itself and pulled back and closed negative, got all the way up to 1095. Pulled back and closed at 1018. For now, this is pretty much being considered a bellwether for the market. Keep an eye on this one. Another bellwether, great day from NVIDIA. We own this, a small position in this with its breakout here. Another 3 weeks till they have earnings. Any consolidation here, we'll be looking to add to our position. This was a really strong right out of the gate and continued higher all day. Minor pullbacks as the market pulled back. On the downside, we sold part of our Upstart. It bounced off the 21 early, but then rolled over and broke the 21. Had a downgrade today, so really was weak out of the gate, but it bounced right off the 21 the way it should have, but then undercut and couldn't get back above it. Your preference on this would have been this continued higher after this first bounce off the 21, but once we get multiple touches and breaks, it might mean that it's time for a longer base. And this thing has run from this 192 breakout all the way up to 400, so more than a double. Not saying it can't double again, saying it just may be time for a base. You've had one test of the 21. Look how it acted there. This was while the market was pulling back. Everything was fine there. But now quickly a second test of it. a bounce and a break is a little bit more cause for concern. So we're lightened up to a very small position on Upstart. Some things that are acting just fine: Bros, new coffee company we've been talking a lot about. We've got positions in this trending higher. And note again, I love to see these things just trend higher along the 8 EMA. That's really, in these go-go stocks, the line that I use. And usually the 8 and the 10 simple are very close to each other. Let's check out Affirm, these other high beta stocks that we have. Note Affirm first close right below the 8 EMA today. So a break of today's low would be a change in character for Affirm, although it has had a very strong run up from 150 to this 165-ish area before it reversed and pulled yesterday and then pulled back again today. So this is actually an evening star pattern. That's a bearish pattern. We don't want to really go below today's lows in Affirm. Let's see what else is acting well. SI, Silvergate, gap down on earnings, but once you get right back above the high of your gap down day on earnings, that's a good sign. It came back, tested the 21 again, and made a higher high. I'm just watching for this to trend higher along the 8 EMA, which is something that CrowdStrike is doing. Broke above. We took our initial position here, added a little bit yesterday, added more when it broke out this morning on really big volume, but it came in along with the market. But again, just watching for this to trend higher above the 8 EMA. When we have these oversized positions, that's what we want it to obey, is the 8 EMA / the 10 SMA. So I've been asked to comment on something I refer to, adjusted beta, all the time. So this is how I track our overall exposure to the market. So the baseline over here on the left side of the chart is the SPY and the SSO. Okay, so the SPY has an approximate average true range on a daily basis of 1.06%. This is the benchmark for the market. Is the S&P 500 has a beta of 1, and everything is compared to the S&P 500's beta and assigned a value based on how it moves versus how the indexes move. So this RVF, this is what we call Revere Volatility Factor. So we assign a baseline of 1 to the S&P 500. The SSO, which is 2 times the S&P, has a beta of 2, and we assign a volatility factor of a 2 for that. So these are really, any stock that we buy, we're comparing where is the beta, where is the ATR versus the SPY and or the SSO, which is really the same thing. One's just a double of the other. And this tells us how to position size. You can have, suppose you had 100% of your account in SPY. On an average day, you would expect an average true range of about 1%. And when you don't own the SPY but you own something else, the first thing you do is there's a beta that pretty much all software packages will track what the beta is, and they'll also track the ATR. The beta can match the ATR very often, or be close to it, or be below it, but the average true range can be significantly higher than the ATR. So this means that your account is going to vary depending on how wide the ATR is, and also how the beta applies and compares to the S&P 500, especially when you look over at the right side of this chart here on some of these strong growth stocks that are leading names but are very volatile. So for instance, let's talk about Affirm right here. So Affirm currently has a 1.1 beta, so you think, well, that's no big deal. And really, before late last year, when I started tracking this closer, at first I would just put in what was the beta of whatever we were holding, and then compare that to the overall market beta to give an idea of where we are. But then I started realizing that the ATR and these are so much more volatile. So even though you've got a 1.1 beta, your ATR is 7.5 times what the S&P 500 means. So if you just looked at beta, you would think this is 10% more volatile than the S&P 500, but it's not. Its ATR is 7.4%. So what we do is combine these two, ATR and beta, and then assign this volatility factor, which ranges from a 1 to a 5. The most volatile ones get assigned a 5, and then we position size based on, one, our stop, but also how volatile the overall position is. Because I mean, taking an 8% position in a stock with a 7% or 8 or 9% ATR, if you have a bunch of those in your portfolio, you can really get an extremely strong down day on a day when everybody is selling growth stocks. So we use this combination of ATR and beta to come up with this volatility factor, RVF, Revere Volatility Factor, and that's also, you'll hear me call it adjusted beta. And when the market is going fully in our direction, we want to get our adjusted beta or RVF up to around 2.0. If the market is not acting well, a 60-40 portfolio would have a beta of 0.6, and we look to get our portfolio down to around that, especially if we're under both moving averages. And really, the portfolio kind of does it by itself, by our stops being hit. But if something is setting up nicely, and during a pullback, it's bucking the trend of the market, showing relative strength, low volume pullback into a moving average, and we add it, we certainly want to be cognizant that we're adding exposure, and how much risk are we actually adding to the portfolio. So when we're in a situation like this where everything is trending higher, on the high side, we're at 2.0. We sold some things today. We just locked in some gains on some pretty volatile things. We had position in TNA, ran straight up off of the volume and off the bottom, and also QLD. And we took those positions. It was 5% in QLD and 3% in TNA. And that reduced our adjusted beta in the portfolio very quickly by, let me calculate it very quickly here. It took 0.27 off of our, it took 0.26 off of our exposure, which was close to a 2. So we, just by selling a couple of things and on an extended market being pulled back, we then reduce our exposure, and then we regroup. We see what other things are on our watch list into low risk entry points. If we get another couple of down days in the market, but we bounce at the 21, that'd be a good opportunity to put some of those on. So the beta today reduced from 2.0, the adjusted beta, down to 1.6. With the stops, I mentioned we sold a little bit of Upstart on the break of the 21. We still have a very small position in this. We trimmed some AMBA, although it was higher by the end of the day, is really standing out. But we had some nice gains in it. It went straight up. It had a negative candle reversal, still riding the ADMA up. Took a little bit of it off, cut it from like an 8% position to a 5% position. And we added to CrowdStrike today. We sold, as I mentioned, ITA, and we also sold PanW. This is just underperforming from a cyber stock standpoint. And when you look up first thing in the morning, and Palo Alto is down 2%, while CrowdStrike is up 3%, the market's telling you which one the leader is. And look at the lack of relative strength over the last week and a half in Palo Alto. When it finally broke this 500 breakout area, and then the 21 today, we sold it for a very small gain. What was left of it was either a very small gain or a very small loss. I'm not sure which, but basically it was break even. So that's going to wrap it. If you have any questions on that adjusted beta, feel free to email me. You can or hit me up on Twitter at dvandenbord, email don@revereasset.com, or phone 855-REAL-WEALTH. Tim will have your Wednesday video. Hunter will have Thursday. I'll be back on Friday with the big show. So wrapping up, Tuesday, October 26th, this is Don Vandenbord telling it like it is. Thanks for listening and have a great day.